Everyone knows Persia changed its name to Iran in 1935. The story you learned frames it as cultural pride, a return to ancient roots, a symbolic gesture. That story is incomplete. The name change was a declaration of economic war. Reza Shah did not ask permission to rename his country. He announced it the same way a debtor announces bankruptcy. The British Empire controlled Persia's currency. They held the printing presses. They decided which banknotes circulated in Tehran bazaars. They kept the gold reserves in London, not in Iranian vaults. When Reza Shah said, "We are Iran now," he was not making a cultural statement. He was declaring that a new financial entity existed, one that would no longer route its monetary sovereignty through British banking halls. The name change came 7 years after he built the first Iranian national bank, 3 years after he started construction on a railway, financed without a single foreign loan, 2 years after he began redirecting trade away from London and toward Berlin. The sequence matters. You do not rename a nation before you control its currency. You control the currency first. Then you announce the new entity to the world. The British did not lose Persia because of nationalism. They lost it because Reza Shah built alternative financial infrastructure. He constructed the machinery that made British banks irrelevant. Oil did not make Iran independent. Banks made Iran independent. The oil was always there. The leverage came when an Iranian institution, not a British one, controlled the flow of money. Welcome to Rashi Historical. We follow the money, trace the power, and expose the history they never taught you in school. This story connects directly to your world today. When China builds the BRICS Bank, they follow Reza Shah's blueprint. When Russia arranges barter deals to bypass sanctions, they use his playbook. When nations talk about de-dollarization, they describe the same structural problem Reza Shah faced in 1925. Foreign powers controlled the currency. Foreign banks held the reserves. Foreign institutions decided which transactions received approval. The technology changed. The fundamental architecture of financial control remains identical. Understanding how one nation broke free explains why others still try. The Imperial Bank of Persia received its concession in 1889. The document granted exclusive rights to issue Iranian currency for 60 years. Read that again. A British bank, headquartered in London, controlled the printing and distribution of Persia's money supply until 1949. This was not a partnership. The bank held Persian gold reserves in London. When Persians needed currency, they requested it from a British institution. The bank decided how much money circulated in the Persian economy. They set the terms. They controlled the bottleneck. The structure worked like this. Persian merchants conducted trade. They earned revenue. They deposited gold and silver with the Imperial Bank. The bank issued paper notes in return, but the reserves stayed in London. The bank maintained minimal gold in Tehran branches. If Persians wanted to redeem their paper for gold, they faced restrictions. The metal sat in British vaults 3,000 miles away. This arrangement gave Britain more control than military occupation. Armies require logistics. Soldiers need supplies. Military control generates visible resistance. Financial control operates silently. A merchant accepts a banknote because he trusts he will be able to use it tomorrow. That trust becomes the foundation of the system. The Imperial Bank built that foundation. Then they built British policy on top of it. The bank issued loans to the Persian government. The Qajar dynasty ran deficits. They needed cash. The Imperial Bank provided it, with conditions. Each loan came with requirements. Trade concessions, tariff adjustments, political alignments. The debt created leverage. Britain used that leverage to extract more concessions, which required more loans. The cycle reinforced itself. By 1925, Persia owed substantial sums to British financial institutions. The government paid debt service in currency issued by British banks. The circularity was not accidental. You cannot achieve financial independence when your creditor also controls your currency supply. The Imperial Bank also financed British commercial operations in Persia. The Anglo-Persian Oil Company received banking services from the same institution that issued Persian currency. Think about that structure. The bank that controlled Persian money also financed the foreign company extracting Persian oil. The conflicts of interest were foundational. Persian merchants recognized the problem. They submitted petitions requesting a national bank. The Qajar government attempted reforms. They failed. The Imperial Bank held a legal concession. Breaking it meant confronting Britain. The Qajar dynasty lacked the strength. Reza Khan took power in 1925. He understood the financial architecture immediately. You do not build a modern state on a currency system controlled by a foreign power. The first priority was not roads, not schools, not even the army. The first priority was the bank. He faced immediate obstacles. The Imperial Bank concession had legal standing. International law recognized it. Breaking the concession would trigger British retaliation, economic pressure at minimum. Military intervention was possible. The British had occupied Persia during World War I. They could do it again. Reza Shah needed a strategy that built alternatives without directly violating the concession. He needed to make the Imperial Bank irrelevant before he challenged it openly. That required constructing a parallel financial system, one that Persian businesses and citizens would choose voluntarily. The approach was surgical. He did not nationalize the Imperial Bank. He did not expel British bankers. He built a competitor. Then he tilted every policy lever to favor that competitor. He changed the machinery beneath the surface. The legal concession remained valid. The actual power shifted. This strategy required patience. You do not replace a 40-year-old banking monopoly overnight. You need capital. You need trained staff. You need public confidence. Most importantly, you need the government to route its transactions through the new institution. Reza Shah began assembling these pieces in 1927. The British watched. Their diplomatic cables show concern but not alarm. They believed the Imperial Bank's legal position was unassailable. They controlled the currency. They held the reserves. A new Persian bank might handle some domestic transactions. It would not threaten British financial dominance. They miscalculated. Reza Shah was not building a competitor. He was building a replacement. Bank Melli Iran opened on September 21st, 1928. The name translates to National Bank of Iran. The translation matters. This was not the royal bank, not the state bank, the national bank. The institution belonged to the nation, not the monarch. The founding capital was 20 million reals. The government provided the initial capitalization. Private investors were invited, but the state maintained majority control. This structure was deliberate. Private banks answered to shareholders. National banks answered to national interests. Reza Shah wanted an institution that would prioritize sovereignty over profit. The bank's charter included one critical provision. Bank Melli Iran received the right to issue banknotes. This directly challenged the Imperial Bank's monopoly. The British concession remained legally valid. But now a second institution held currency issuing authority. The monopoly was broken through addition, not subtraction. The Imperial Bank protested. British diplomats filed objections. They cited the 1889 concession. They argued Bank Melli's currency issuing authority violated international agreements. The Persian government responded with legal precision. The Imperial Bank held exclusive rights to issue banknotes. Bank Melli Iran issued different banknotes. Both circulated. Merchants could choose which to accept. The market would decide. This was financial warfare, disguised as free market competition. Reza Shah then implemented the forcing mechanism. He ordered all government ministries to deposit their funds in Bank Melli Iran. Tax revenues went to the national bank. Payroll went through the national bank. Government contractors received payment from the national bank. This created immediate demand for Bank Melli currency. If you wanted a government contract, you needed a Bank Melli account. If you paid taxes, you received a Bank Melli receipt. If you worked for the government, you got paid in Bank Melli notes. The network effects compounded rapidly. The bank opened branches across Persia. Small cities, provincial towns, places the Imperial Bank considered unprofitable. Bank Melli went there anyway. Profitability was secondary. The objective was ubiquity. A merchant in Tabriz needed access to the same banking system as a merchant in Tehran. Bank Melli provided it. The institution also offered better terms than the Imperial Bank. Lower fees on transactions, higher interest on deposits, faster service. These advantages were possible because Bank Melli optimized for market share, not quarterly returns. They were buying the future. Training staff was a bottleneck. Persia lacked experienced bankers. Reza Shah sent students to Europe for financial education, France, Germany, Switzerland. He avoided sending them to Britain. When they returned, they joined Bank Melli. The institution became the training ground for Persian financial expertise. The bank also introduced modern accounting standards. Double-entry bookkeeping became mandatory. Audits were regular and published. Transparency built trust. Persian merchants saw the books. They compared them to the Imperial Bank's opaque operations. The contrast worked in Bank Melli's favor. By 1930, Bank Melli Iran held significant deposits. Government money, merchant money, individual savings. The reserves stayed in Tehran. This was the critical difference. When you deposited gold with Bank Melli, the gold stayed in Persian vaults. You could verify it. You could withdraw it. The metal was not in London. The Imperial Bank responded by tightening credit. They made loans more expensive for Persian businesses. This backfired. Expensive Imperial Bank credit drove borrowers to Bank Melli. The National Bank offered better rates. Persian businesses switched. The British attempt at financial pressure accelerated their own marginalization. Currency exchange became the next battlefield. Bank Melli, notes, traded at par with Imperial banknotes initially. Then Reza Shah announced tax payments would only be accepted in Bank Melli currency. This created automatic demand. If you owed taxes, you needed Bank Melli notes. The currency gained a structural advantage. The Imperial Bank's notes did not disappear. They continued circulating. But the momentum shifted. More transactions happened in Bank Melli currency. More deposits flowed to Bank Melli branches. The network effects that once favored the British now favored the Persians. By 1932, Bank Melli Iran was the dominant financial institution in Persia. The Imperial Bank still operated. It still held its concession. But it no longer controlled the currency supply. It no longer set the terms. It had become one bank among several. The monopoly was dead. Reza Shah achieved this without nationalizing British assets, without expelling British bankers, without violating international law. He built a better system. Then he made sure everyone used it. The British could not claim their property was seized. Their property was simply made obsolete. This strategy mattered because Reza Shah was planning something bigger, a project that would require enormous capital, a project that would define Persian independence for generations. He needed Bank Melli operational and dominant before he announced it. The railway was coming. Reza Shah announced the Trans-Iranian Railway project in 1927. The announcement included one detail that shocked foreign observers. The railway would be built without foreign loans, zero external debt. Persia would finance the entire project through internal revenue. This was unheard of. Every major infrastructure project in the developing world ran on European capital. The Suez Canal, the Ottoman railways, the Indian rail network, all built with European loans. Those loans came with conditions, trade concessions, territorial rights, political influence. The debt created leverage. European powers used that leverage to expand control. Reza Shah studied those examples. He saw the pattern. Borrowing for infrastructure meant surrendering sovereignty. The project might get built, but you lost control of your economy in the process. Egypt learned this lesson. The Ottoman Empire learned it. Persia would not repeat their mistakes. The financing mechanism was elegant. Reza Shah imposed new taxes on sugar and tea imports. These were luxury goods. Demand was stable. The taxes were predictable. Revenue flowed directly into a dedicated railway fund. The fund could not be raided for other purposes. Every real collected went to construction. The sugar and tea taxes generated approximately 2.6 billion reals over the construction period. That was enough. The railway was expensive, but it was not impossible. The key was discipline. The fund accumulated. The construction proceeded. No debt was issued. European banks offered financing anyway. British institutions, French banks. They proposed loans at attractive rates. Reza Shah refused all of them. The offers were not about helping Persia. They were about creating dependency. A loan creates a creditor. A creditor gains leverage. Leverage becomes control. Reza Shah wanted infrastructure, not new masters. The construction began in 1927. European engineers said the timeline was unrealistic. The terrain was too difficult. The funding was insufficient. Persia lacked the technical expertise. The project would fail or require foreign rescue. They were wrong. Reza Shah hired engineers from multiple countries: Germans, Italians, Scandinavians, Americans. He avoided concentrating expertise from any single nation. If British engineers dominated, Britain gained leverage. If French engineers controlled the project, France gained influence. Diversifying the expertise prevented any foreign power from becoming indispensable. The construction employed tens of thousands of Persian workers. They learned by doing. European engineers supervised initially. Persian engineers gradually took over sections. By the end of the project, Persian engineers managed significant portions independently. The railway was not just infrastructure, it was a training program. The route selection was strategic. The line connected the Caspian Sea to the Persian Gulf, north to south. This orientation was deliberate. It did not connect Persia to British India in the east. It did not connect to Russian territories in the north beyond the Caspian terminus. The railway served Persian interests. It linked Persian cities. It moved Persian goods. It was not built to facilitate foreign trade. It was built to unify the nation. The project faced legitimate obstacles. Mountain tunnels required advanced engineering. Bridge construction over deep gorges tested technical limits. Funding pressures emerged when construction costs exceeded estimates. Reza Shah responded by imposing additional taxes: tobacco, matches. He found the revenue domestically. He did not borrow. The railway opened in stages. The first sections became operational in the early 1930s. Full completion came in 1938. 11 years from announcement to completion, entirely debt-free. The accomplishment was unprecedented for a developing nation. The economic impact was immediate. Transport costs dropped dramatically. Goods moved from the Caspian to the Gulf in days instead of weeks. Internal trade expanded. Markets that were previously isolated became connected. The railway created a unified economic space. The strategic impact was deeper. The railway meant Persia could move troops rapidly from north to south. Regional powers could not isolate one part of the country and pressure it separately. The central government could project power across the entire territory. The infrastructure created state capacity. The railway also demonstrated something profound to the Persian population. Large projects were possible without foreign control. Modernization did not require surrendering to European powers. The railway was proof. You could see it. You could ride it. It worked. And Persia owned it completely. This lesson extended beyond infrastructure. If Persia built a railway without foreign loans, what else was possible? Could Persia industrialize without European capital? Could it modernize its military without foreign advisors? Could it control its oil without British companies? The railway made these questions thinkable. The British watched the railway's completion with growing concern. Their diplomatic cables show clear worry. An independent Persia was manageable. A Persia with modern infrastructure and no foreign debt was dangerous. The The railway changed the strategic equation. The timing mattered. The railway reached completion as European tensions escalated. Germany was rearming. War was approaching. Britain needed reliable supply routes to India. Russia needed southern access. Both powers wanted influence in Persia. But Persia now had infrastructure that did not depend on either of them. Reza Shah built the railway to create options. Those options were about to become very valuable. German-Iranian trade was minimal in 1933. By 1939, Germany accounted for 45% of Iranian foreign trade. That shift was not accidental. Reza Shah deliberately redirected Iranian commerce away from Britain and Russia toward Germany. The strategy was about diversification. More precisely, it was about breaking British economic encirclement. Britain controlled the currency through the Imperial Bank until Bank Melli replaced it. Britain dominated trade through long-established commercial networks. British firms imported manufactured goods into Persia. British ships carried Persian exports. British insurance companies covered the cargo. British banks financed the transactions. Even after Bank Melli broke the currency monopoly, Britain still controlled the trade infrastructure. Germany offered an alternative. German firms wanted raw materials. Persia had them. Persia wanted industrial equipment. Germany made it. The natural complementarity created opportunity. But the trade structure mattered more than the volume. Germany proposed barter arrangements, oil and agricultural products from Persia, machinery and industrial goods from Germany. No currency exchange required. No British banks involved. No transactions in pounds sterling. The trade bypassed the financial infrastructure Britain controlled. Barter trade sounds primitive. It was actually sophisticated financial engineering. When you trade oil for machinery directly, you eliminate currency risk. You avoid exchange rate manipulation. You exclude third-party financial institutions. Most importantly, you make sanctions difficult. Britain could freeze Persian sterling accounts. They could pressure British banks to stop serving Persian clients. They could not stop a direct exchange of physical goods. Reza Shah understood this. The barter arrangements were not about avoiding modern finance. They were about avoiding British-controlled finance. The distinction is critical. The trade composition reveals the strategy. Germany sold industrial equipment to Persia. Machine tools, factory machinery, railway equipment. These were capital goods. They built productive capacity. British trade with Persia was different. Britain sold consumer goods, textiles, finished products, items that created dependency rather than capability. German engineers accompanied the machinery. They trained Persian workers. They established maintenance protocols. The technology transfer was real. Compare this to British oil operations. The Anglo-Persian Oil Company employed British engineers and British managers. Persians worked as laborers. The British model extracted resources. The German model built capacity. This difference was not about German generosity. Germany needed markets. They needed resources. But their bargaining position was weaker than Britain's. They could not offer established networks or reserve currency. They had to offer something else. Technology transfer and favorable terms were what they had available. Reza Shah exploited that. The trade expansion alarmed Britain. British diplomatic cables from 1937-1939 show escalating concern. They describe the German economic penetration as a strategic threat. They were correct. Economic dependence creates political alignment. As Persian trade shifted toward Germany, Persian policy became more independent from British pressure. The British tried to counter with their own trade offers, better terms, increased volumes, technology sharing. The offers came too late. The infrastructure had already shifted. Persian merchants had German contacts, factories had German equipment, engineers had German training. Reversing this required more than better prices. It required rebuilding the entire network. Britain had lost momentum. The German relationship gave Reza Shah leverage in another way. Britain feared Persian alignment with Germany. That fear made Britain more cautious about pressuring Persia. If Britain pushed too hard, they might drive Persia completely into the German sphere. The triangle created room for Persian maneuver. Russia watched the German expansion with equal alarm. Soviet diplomatic records show repeated attempts to limit German influence in Persia. They offered trade deals. They proposed infrastructure cooperation. Reza Shah took some offers. He rejected others. He played the powers against each other. This balancing act required precision. Too much German alignment and Britain might intervene militarily. Too much British accommodation and the independence project would stall. Reza Shah had to maintain multiple relationships while committing fully to none. The trade diversification gave him the tools. The German relationship also provided military equipment. Persia's army modernized with German weapons. German advisors trained Persian officers. This was not a formal alliance. It was commercial and technical cooperation. But it reduced Persian dependence on British and Russian arms supplies. By 1939, Persia had diversified its economic relationships substantially. Germany was the largest trading partner. Britain maintained significant trade. Russia had limited engagement. Smaller European nations held minor positions. No single power dominated. This was exactly what Reza Shah wanted. The structure was fragile. It depended on European powers competing for influence. If they cooperated to limit Persian independence, the strategy would collapse. That is precisely what happened when World War II began. In 1941, Britain and Russia invaded Persia jointly. They cited German influence as justification. They needed the Trans-Iranian Railway to supply Russia with war material. They forced Reza Shah to abdicate. His son replaced him as a much weaker monarch. The occupation ended Persian independence temporarily, but the institutions survived. Bank Melli Iran continued operating. The railway kept running. The industrial base remained. When the occupation ended, these institutions provided the foundation for renewed independence. The infrastructure outlasted the invasion. The German relationship demonstrated a principle. Diversification creates resilience. A nation dependent on one trading partner has no leverage. A nation with options can negotiate. Reza Shah built those options deliberately. The strategy was not about loving Germany or hating Britain. It was about creating structural alternatives to British control. This approach reappears throughout history. Nations seeking independence from dominant powers use the same playbook. Find alternative partners, build alternative infrastructure, create options. Then use those options as leverage. The specific partners change. The structure remains constant. On March 21st, 1935, the Persian government sent a notification to foreign embassies. The official name of the country was now Iran, not Persia. Foreign governments would use Iran in all diplomatic correspondence. The change was not a request. It was an announcement. The Western press covered it as a cultural gesture. A return to the ancient name, nationalist sentiment. The coverage missed the point entirely. The timing was not coincidental. Bank Melli Iran had been operating for 7 years. The Trans-Iranian Railway was under construction and visibly progressing. German trade had expanded significantly. The financial and economic infrastructure was operational. The name change came after the system change, not before. A name is a legal entity. When a company changes its name, contracts must be updated. Agreements must be rewritten. Legal standing shifts. The same principle applies to nations. When Persia became Iran, existing agreements faced ambiguity. Did treaties signed with Persia automatically apply to Iran? Legal scholars could argue both sides. This ambiguity gave Reza Shah renegotiation leverage. The Imperial Bank held a concession granted to Persia. Did that concession bind Iran? The question was not rhetorical. It had legal weight. The British argued continuity. The Iranian government suggested the matter required review. The debate created space for pressure. Several older treaties faced similar questions. Commercial agreements, territorial understandings, diplomatic protocols, all signed with Persia, all potentially subject to reinterpretation under the new name. Reza Shah used this uncertainty to push for modifications favorable to Iran. The name change also signaled a psychological shift. Persia carried associations with Western Orientalist fantasy, the exotic East, ancient empires long fallen, a place Europeans had studied and categorized. Iran was different. Iran was the indigenous name, the name Persians used for themselves. Adopting it meant rejecting the European framing. This mattered in negotiations. When British diplomats dealt with Persia, they carried assumptions, historical patterns, established hierarchies. Iran was new. It had no established pattern of deference. The British had to recalibrate their approach. Small shifts in diplomatic tone created openings. The name also unified internal identity. Persia was the Greek name for the dominant ethnic region. Iran meant land of the Aryans, in the ancient sense. It was inclusive of all Persian-speaking peoples, Azerbaijan, Kurdistan, Baluchistan. The name emphasized shared identity over regional distinctions. This supported centralization. Centralizing power was essential to Reza Shah's project. A fragmented nation could not maintain independence. Regional elites could be bought by foreign powers. Tribal leaders could be turned into proxies. Unity was not just cultural preference, it was structural necessity. The name change was part of building that unity. The economic dimension was most significant. When foreign businesses signed contracts with Persia, they dealt with a nation whose currency was issued by a British bank. When they signed contracts with Iran, they dealt with a nation that controlled its own currency. The entity had changed substance, not just name. Bank Melli Iran used the name deliberately. National Bank of Iran, not Persia. The bank predated the official name change by 7 years. Reza Shah was signaling future direction. When the country officially became Iran, the bank's name was already aligned. The financial institution and the nation shared identity. The railway followed the same pattern. Trans-Iranian Railway, not Trans-Persian Railway. The name described the new entity, not the old one. When foreign engineers worked on the project, they worked for Iran. The infrastructure belonged to Iran. The name established ownership. Critics called the name change superficial. They were wrong. Names carry legal weight. They define identity. They shape perception. Changing the name was part of changing the reality. You do not announce a new identity before you build the substance to back it. Reza Shah built Bank Melli first. then the railway, then diversified trade. Then he announced the new name. The sequence was strategic. The international response varied. Germany adopted Iran immediately. They had no attachment to the old name. Adopting the new one built goodwill. Britain resisted initially. They continued using Persia in some official correspondence. This was not accidental. Accepting the name change meant acknowledging the shift in status. Britain wanted to deny that shift. Eventually, Britain adopted Iran officially. They had no choice. The Iranian government insisted. Refusing would have created diplomatic friction over a symbolic issue. Britain had larger concerns. They conceded on the name, but they understood what it represented. The name change completed a transformation that began in 1925. Persia was a weakened state with foreign-controlled currency and infrastructure. Iran was a centralized nation with its own bank, debt-free railway, and diversified trade. The two entities were fundamentally different. The name marked that difference. Language matters in power relationships. The dominated accept names imposed by the dominant. The independent choose their own names. Persia was the name Europeans used. Iran was the name chosen by the nation itself. That choice was an assertion. We define ourselves. You will use our terminology. This principle extends beyond Iran. Colonial powers renamed territories. They imposed European names on cities, regions, countries. Independence movements reversed those changes. Bombay became Mumbai. Rhodesia became Zimbabwe. Burma became Myanmar. Each change was a declaration. The era of accepting foreign definitions had ended. Reza Shah's name change was early in this pattern. It came before decolonization spread globally. It set precedent. Other nations watched. If Iran could assert its own identity successfully, others could follow. The symbolic became structural. The 1935 name change was not the final step. It was a milestone. The institutions continued developing. The economy continued modernizing. But the name marked a point of no return. Going back to Persia would mean going back to foreign-controlled currency, to debt-dependent infrastructure, to British economic dominance. The new name represented a new reality. Iran would not return to being Persia. Reza Shah's program followed a specific sequence. Control the currency first, build debt-free infrastructure second, diversify trade relationships third, assert new identity fourth. The order was not random. Each step created the foundation for the next. You cannot build expensive infrastructure without controlling your currency. Foreign-controlled money means foreign veto over major projects. The Imperial Bank could have strangled the Trans-Iranian Railway by restricting credit. Bank Melli eliminated that choke point. You cannot diversify trade without infrastructure. The railway connected northern and southern Iran. It made internal trade viable. It reduced dependence on coastal shipping, which Britain controlled. Physical infrastructure enabled economic diversification. You cannot assert a new identity without economic substance. Names without institutions are empty. Iran backed its name change with a national bank, a completed railway, and diversified trade relationships. The substance made the assertion credible. The sequence reappears in modern efforts to achieve financial independence. Nations following the same path use the same steps. The technology changes. The fundamental architecture remains identical. China built the Asian Infrastructure Investment Bank before expanding the Belt and Road Initiative. Bank first, infrastructure second. The sequence matches Reza Shah's approach. The AIIB provides financing outside Western-dominated institutions. Belt and Road projects use that financing. The infrastructure reduces dependence on Western-controlled trade routes. The parallel is exact. Russia's response to sanctions follows the same logic. Build alternative payment systems, develop barter arrangements with friendly nations, reduce dollar dependence. The tactics match Reza Shah's German pivot. When Western financial systems become weapons, you build alternatives. You find trading partners willing to use those alternatives. You gradually shift the infrastructure. The BRICS expansion represents the institutional layer. Brazil, Russia, India, China, South Africa. Now expanding to include Iran, Saudi Arabia, UAE, Egypt, Ethiopia. The group is building alternative financial institutions, the new development bank, alternative payment systems. The objective is reducing dependence on dollar-dominated finance. This is Bank Melli at global scale. Iran's inclusion in BRICS is historically resonant. The nation that built the first modern alternative to British financial control now joins the coalition building alternatives to American financial dominance. The institutional memory runs deep. Iran pioneered this approach. They understand the strategy. Digital currency development represents the latest iteration. China's digital yuan, Russia's digital ruble. These are not just technological upgrades, they are sovereignty tools. A central bank digital currency gives you complete visibility and control over transactions. It eliminates dependence on SWIFT and Western payment networks. It is monetary sovereignty for the digital age. The fundamental challenge remains constant. The dominant power controls the financial infrastructure, the reserve currency, the payment systems, the major banks. Breaking free requires building parallel systems. then making those systems attractive enough that others adopt them. Network effects work for the incumbent. You need superior functionality or political necessity to overcome that advantage. Sanctions create political necessity. When the United States freezes reserves and cuts nations out of SWIFT, it demonstrates system risk. Nations observing this treatment recognize their vulnerability. They begin building alternatives, not because they plan to challenge the United States immediately, because they want options. The desire for options drives the development of alternative infrastructure. Reza Shah faced the same dynamic. British financial control was tolerable until it became a weapon. When Britain used its banking position to extract political concessions, it created the necessity for alternatives. Bank Melli was the response. The Trans-Iranian Railway was the follow-through. The modern system faces the same trajectory. Dollar dominance was acceptable when it was primarily about trade efficiency. When it becomes a coercive tool, it generates resistance. That resistance takes the form of alternative institutions. BRICS, AIIB, digital currencies, bilateral swap lines, barter arrangements. Each piece reduces dependence slightly. Accumulated over time, they shift the structure. The process is slow. Bank Melli took years to displace the Imperial Bank. The railway took 11 years to build. Trade diversification happened gradually. Financial infrastructure has enormous inertia. Changing it requires sustained effort. But the direction is clear once the effort begins. Reza Shah's program also shows the limits. He built impressive independence, but it was not absolute. When Britain and Russia invaded in 1941, the institutions could not prevent occupation. Financial sovereignty does not guarantee military security. The structure survived, but they could not protect the regime. This lesson applies today. Financial independence increases options. It does not eliminate vulnerability. A nation with its own currency and infrastructure has more policy space. It still operates in a world with military power, resource constraints, and geopolitical pressure. The institutions create resilience. They do not create invulnerability. The institutions do outlast individual rulers. Reza Shah was forced to abdicate. Bank Melli survived. The railway continued operating. The industrial base remained. When occupation ended, these institutions provided continuity. The infrastructure proved more durable than the political regime. This matters. Building institutions is different from building personal power. Personal power dies with the person. Institutional power persists. Reza Shah built institutions. That is why his influence extended beyond his reign. The bank still exists. The railway still operates. The precedent still guides policy. Modern nations attempting financial independence face a question. Are you building personal power or institutional capacity? Personal power is faster. You centralize authority. You make decisions rapidly. But it disappears when you leave. Institutional capacity takes longer. You build systems. You train people. You establish procedures. But it persists. Reza Shah chose institutions. Bank Melli was not his personal bank. It was a national institution. The railway was not a royal project. It was national infrastructure. He maintained control during his reign, but the ownership was structural, not personal. That choice created durability. The financial architecture he built had one more feature worth examining. It was defensive, not aggressive. Reza Shah did not try to make the rial a regional reserve currency. He did not attempt to build an empire. He focused on making Iran economically independent. The scope was national, not imperial. This restraint was strategic. Challenging British dominance globally would have triggered overwhelming response. Building Iranian independence was achievable. Britain could not afford to occupy every nation that built its own bank. They could respond to existential threats. Iranian independence was a setback, not an existential threat. Modern challengers face the same calibration question. Do you challenge dollar dominance directly or build alternatives gradually? Direct challenge invites maximum resistance. Gradual alternative building is harder to counter. The BRICS approach follows the gradual path. Build institutions, expand membership. Increase usage slowly. Avoid direct confrontation while steadily reducing dependence. Reza Shah's blueprint provides a template. Control your currency. Finance infrastructure without foreign debt. Diversify economic relationships. Build institutions that outlast individuals. Move deliberately. Avoid premature confrontation. The specific context changes. The strategic logic remains applicable. The 1941 invasion interrupted the program, but it did not destroy it. The institutions survived occupation. They provided the foundation for the next phase of Iranian development. The oil nationalization of 1951 was possible because Bank Melli existed. The infrastructure built by Reza Shah made later independence movements viable. This is the final lesson. Financial independence is not a one-time achievement. It requires constant maintenance. The institutions must adapt. The international environment changes. New pressures emerge. But the foundation, once built, provides resilience. Iran built that foundation between 1925 and 1941, 16 years, one generation. The impact lasted far longer. The institutions shaped Iranian policy for decades. They shape it still. Bank Melli remains the largest Iranian bank. The railway still operates. The industrial base traces back to that era. The infrastructure created path dependence. Your world runs on similar infrastructure. The Federal Reserve, the dollar system, SWIFT, the World Bank. These institutions shape what is possible. They define who has options and who faces constraints. Understanding how one nation built alternatives explains why others try. The tactics evolve. The strategy is timeless. Control the currency. Build without debt. Diversify relationships. Create institutions. The blueprint still works. That is why nations still follow it.